Hi, and welcome to the ChooseFI Foundation's Educational Speaker Series, where we take topics from the ChooseFI Foundation's pre-K through 12 financial literacy curriculum and break it down with expert speakers in the area to bring a little bit more information and ideas to the topic. Hope you enjoy it.
Hey everyone, this is Rob Phelan. I'm here with Brian Feroldi, contributor to The Motley Fool and solar panel enthusiast. That's how he wanted to be introduced, guys. Brian, how you doing?
Doing awesome, Rob. Awesome to be here.
Thank you so much for joining us. We are going to talk about stocks today and really want to break it down for all you guys watching, because for a lot of us, the first time we want to start getting involved in investing, it's a little bit scary because it's a big concept to try and understand. Like, we don't really get to hear much about stocks when we're growing up. Like, it's not something that comes up in, children's, teens conversations very much. So we really don't know much about it before we get started. And Brian and I want to try and break that down for you today as to what stocks are and how you can get started investing. So Brian, what is a stock?
Good question. A stock, in a very real way, represents ownership of a business. That's it. A stock is a piece of paper, or more likely nowadays, something that's digital, that the owner of that piece of stock owns a small part of a company. So for example, one of the largest companies in the world right now is Microsoft, which I'm sure many people are familiar with. They own Xbox. They make all the things related to Xbox. In a very real way, anybody can be a part owner of Microsoft by going out into the market and buying one share of the company. When you do that, you become a literal part owner. You own all of the company's assets and all of the company's revenue and profits. That is in a very real ways yours when you buy that stock.
Okay. And what is the difference then between a stock and a share? Because I hear share come up sometimes as well. Is it the same thing?
Same thing, just different ways of saying the same thing.
Okay, so you're a part owner. What does that entitle you to? Like, can I have any sort of say in how Microsoft is run? Could I say, you know what, I want that little microchip. I own part of this company. That microchip is mine. Or how does this work?
Sure. You do get a vote. When you become a shareholder, you do get a vote. Every share that you own entitles you to a vote to say what happens. However, with a company like Microsoft, there are billions of shares outstanding. And while you may have one vote if you own one shares, there are billions of other votes that go against that can go against yours. So you are a very, 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 very small part owner of the business, but that doesn't mean that you can go in there and boss people around and set the CEO and make the rules.
Yeah, it's like I thought first when I owned my first share of Starbucks that I could walk up to a Starbucks window and be like, I technically part own this place. Like, just give me coffee. No, it didn't work that way.
Darn.
I know, if only. Like, I'm technically your boss. I own part of this company. No, it doesn't work. Why do businesses go public? So this idea of why can the public be allowed to own part of a company, and why would I want to do that? I mean, like, why do I want to own part of Microsoft, especially if it's like such an insignificant amount that I don't really get any say in how it works? Like, what's the reason for this? Why does it exist?
Sure. Well, let's start with why companies go public. Why would a company bother doing that? Companies are different entities than you or I. When a company wants to raise money, let's say it's in its growth phase. Let's take Facebook, for example. In a few years ago, Facebook went public. They created shares of stock, and they sold those shares to the public. In exchange, the people that bought those shares gave Facebook money. So Facebook made these shares that represented ownership in the company Facebook and sold them to the public. The public gave Facebook money in exchange for that. So on the day that Facebook went public, it raised billions of dollars. So in one day, Facebook's bank account went up by literally billions of dollars. In exchange, it had to sell ownership of all of its properties, which includes Facebook, Instagram, WhatsApp, etc. So the public now owns a portion or has a claim on Facebook's assets as well as its profit stream. So as Facebook makes money, the people that bought that stock have a permanent claim on Facebook's profit. The reason that people go out and buy shares of stock is that they want to earn a return on their investment. So when Facebook came public, the company was valued at around $44 per share. Fast forward to today, Facebook is currently trading around $210 per share. So those people that bought Facebook stock on the first day for $44, that has appreciated in value to now worth over $200. So just by buying and holding Facebook, they have earned about 4 times their money. So for every dollar in Facebook stock that they bought on day one, it's now worth $4. That's the reason that we invest in companies, is to earn a return on our money.
Okay. So it's just kind of like, I want to own this for a little bit of time, hope that it goes up in value, and then someday I'm probably going to sell it so that I can realize that, that gain. So like if I'm taking the Facebook example, I put 44 in, it's now worth 210. So when I eventually sell my Facebook stock, I can take that $210 and it's mine to now spend, do what I want with, right?
Correct. That's
Okay.
one way that investors can make money by owning stocks. There is a second way that investors can make money by owning stocks. Facebook is profitable, meaning that it takes in more money from selling advertisements on its business, on its properties, than it costs to run Facebook. It's very profitable, actually. It makes billions of dollars each year in profits. Lots of companies are very profitable. Let's take another one that I'm sure everyone here has heard of. Apple. Mm-hmm. Apple makes money by selling iPhones, iPads, iMacs, the App Store, and a whole bunch of different ways. Apple makes billions of dollars in profits each year. In fact, last year, Apple made $55 billion in profit, 55 billion with a B. Now, that has caused Apple's stock to steadily appreciate over time. It has also gone up a lot over time. However, Apple has chosen to take some of its $55 billion in profits and pay that out in cash to its shareholders. That process is called a dividend, when a company takes some of its profits and gives it back to its shareholders in a form of a cash payment. So that is another way that Apple has rewarded its shareholders. For every 1 share of Apple stock that you own, Apple is currently paying $3.28 per share in dividends, which means if you hold on to that Apple share for 1 year, you're going to get $3.28 as a cash payment into your account, similar to kind of like an interest rate. Now, 1 share of Apple stock currently costs about $315. So that's an interest rate of about 1%.
Okay. And so you said that when companies become profitable, they can give out these dividends. So I guess an unprofitable company, there is no dividends to share because there's no profit to divide up, right?
That would be correct.
And does a company have to pay a dividend when they become profitable?
No, they do not.
Okay, so it's a choice.
It is a complete choice, yes.
So why would they do it?
And yeah, that's a good point. Not every company pays a dividend. In fact, there's lots of companies that are very profitable, but do not pay any dividends at all. The biggest one that I can think of would be Amazon. Amazon is worth $1 trillion or so, and they don't share any of their profits with investors. Instead, Amazon is keeping all of its profits and using that money to make itself bigger, to hire more people, to build more warehouses, to add servers, to launch in new markets. Amazon is taking all of its profits and reinvesting in its business to grow and grow and grow and grow. That is a choice that some companies make. Another one that is doing that same thing is Alphabet, which is probably better known as Google. Alphabet is the holding company that owns Google and all of Google's properties. Alphabet also does not pay a dividend. It keeps all of its cash and reinvests in itself to continue to grow and grow and grow. eventually, I would expect that Amazon, Google, and even Facebook would eventually take some of their profits and start to return it to their investors as a dividend.
Okay, so they reward people for kind of being an owner of the company eventually.
Yes.
All right, so a question I've always had, and I never could figure out, was why do companies care about what their stock price is after they've already had that first, selling point? Because I think I've heard before that businesses don't actually make any money from their stocks trading hands after they do that first initial public offering. So when they first go public and they raise all that money, so you said Facebook raised billions. After that, Facebook doesn't make any money from people buying and selling Facebook stock, right?
That's correct. After Facebook sells its initial stock to the public, it doesn't get any additional capital from its stock going up. So Facebook, the company, doesn't directly benefit from its stock price going up. It doesn't get any additional capital. However, everybody that owns Facebook stock does benefit from the stock going up. So who owns Facebook stock? Well, the number one shareholder of Facebook is Mark Zuckerberg. He's its founder. He literally has billions of dollars of his own net worth is invested in Facebook stock. So as the price goes up, Mark Zuckerberg gets wealthier. So does every other shareholder of Facebook. Remember before we talked about how shareholders get a vote?
Yes.
Well, those shareholders really care about the price of Facebook going up. If the leadership team at Facebook was failing to grow and make its stock price grows up, those shareholders could come in and fire the management team and put in new management teams and incentivize them to make the stock price go up. So while the company doesn't necessarily benefit directly, it's very common for the managers of that company to own the stock themselves. And by owning it themselves, they want to see the stock price go up.
Okay, so it's a good kind of personal incentive to make sure the business keeps running well. So they can't just do this initial public offering, make a ton of money from the public, and then be like, all right, guys, see ya, we're riding off into the sunset with your money.
Well, they certainly could. and not every company is a good investment. In fact, most companies that are publicly traded lose money for their investors. It's only a minority of companies that go on to make money for their investors. So investing and identifying great businesses to buy is very difficult. However, that doesn't mean that the managers of those businesses and the people that own those stocks don't want them to go up. So all companies have an incentive to see their share price go up, even if they don't benefit directly from that themselves.
Okay, good to know. And I know that painted a little bit of a scary picture that like, oh, not every business is a good investment and that there is some picking to this. We're going to come back and talk about that in a little bit about how you can reduce the risk of picking bad businesses and so on. So let's talk about buying a stock or share. How do we do that? Let's start there. How do you actually go and get started with buying a stock of a company?
It's very simple. You open up an account with a broker. And a broker is kind of like a bank, except for it's a bank that you put money in, and you can use the money that you put in to buy and sell stocks. There's lots of them to choose from. Some of the biggest and most well known are Fidelity, Charles Schwab. A very popular one with millennials is an app called Robinhood, which is what you can put money into. And once your money is in there, it's just like ordering anything else. You say, I want to buy this stock or this mutual fund or this index, and here's the money. And you place the order and they go out and fill the order for you.
Yep, it is that simple, guys. You find a brokerage account of some sort. So Brian just gave us a couple examples. There are lots of them out there. Make sure you do your research. One thing I would say for you when you're getting started is that you should not be paying any fees for your transactions. So when you're getting started, you're looking for a brokerage account that does not have fees for buying and selling stocks. So Robinhood was a good example of that, where you can buy and sell stocks and there's no fee every time you buy or sell. What really kind of confused me at first was the price of a single stock. So when I was looking in the beginning at buying stocks, it was like, Amazon is over $1,000 for one stock. but Apple was only like $150 at the time. So Amazon must be like 10 times the size of Apple, right?
Yeah, it's very confusing.
Yeah. So what is
It's
that? What does the stock price kind of tell us about a company, or what like why are some really high, some really low, and sort of?
Yeah, the price of a stock actually tells you very little, if not next to nothing about the business. And it's the only aspect, it's the only time that the price of a stock, a price of something is not a signal. If anybody here walked into Kohl's and they saw that a sweater was $1,000 and that another sweater was $20, everybody here knows that the $1,000 sweater is super expensive and the $20 sweater is very reasonable. So it's natural to look and do exactly what you just did and say, wow, one share of Amazon currently costs $2,426 and one share of Apple costs $314. So based on that alone, you must think that Apple is smaller or cheaper than Amazon. However, the price of a stock is completely different than the price or the value of a business. The value of a business has two components to it. First is the price of one share, that we know. The second thing is how many shares exist. And companies have complete control over how many shares of the company exist. We know the prices of these stocks. We know that Amazon trades for $2,400 and Apple trades for $315. What we don't know is how many shares are outstanding. So we know the price of one share, but we don't know how big the entire company is because we have to take the price of one share and multiply it by all of the shares that are outstanding.
And outstanding just means like how many shares they actually issued, like how many are out there in the world, right?
Exactly.
Okay.
Yes. Thank you for clarifying.
Not that they are an outstanding share.
Well, these are two pretty outstanding companies.
True.
So let's do Apple first. Apple has 4.4 billion shares outstanding, 4.4 with a B. So to find out how big Apple is, we take the current share price, 315, and we multiply by 4.4 billion, and that gives us the size of Apple. Apple is worth $1.3 trillion, trillion with a G. Absolutely enormous.
A lot of zeros, guys.
It is a lot of zeros. Let's do Amazon now. Amazon, remember the share price, one share costs $2,400. But Amazon only has 502 million shares outstanding. So Apple was 4.4 billion. Amazon is 502 million. So way less shares outstanding. However, you multiply $2,400 per share times 500 million, and you see that Amazon is worth 1.2 trillion. Okay. So although its share price is higher, much higher than Apple's, Amazon is actually smaller than Apple, the company. So that's why you can't just look at the share price to figure out how big a company is. You have to look at the share price, multiply it by the number of shares that are outstanding that exist in it for that company. And the number of shares that a company has is a totally made up number. Any company can determine how many shares that they want outstanding, how many shares they have, and they can control that number as they see fit. So that's why you can't just look at the share price.
Okay, that's great information to know. So, and because Amazon has less shares, if you did manage to save up and own one of those shares of Amazon, you technically do own a bigger fraction of the company. But in the same breath, if you had bought I forget what the share price of Apple was, but say like you bought 3 or 4 shares of Apple, you're almost on par with the fraction of the company that you would own. So it really comes down to the dollar amount you have invested in that stock as opposed to like the number of shares, because it's going to go up or down usually by a percentage. So as the company grows, your investment will grow. So really it's not about the number of shares, it's about the dollar amount you have. Like you could have 100 shares of a $2 stock, and so you've got $200 invested. And if you have $200 invested in Apple, you have the same amount of money invested in both companies.
That's the key point. It doesn't matter how many shares you own. It matters what's the value of your investment in the company, which is very confusing. When I first started out investing, I thought I should just buy stocks that trade for $1 or less because they're cheaper. And I wanted to own a lot of shares. It turns out that companies that trade for under $1 do so typically because they're terrible companies.
Yes. Cheaper does not necessarily mean better. And typically, is there like a sweet spot for you that you're like, if a share is under this price, you're probably not interested in that company?
Yes. Typically, I don't look at companies that are under $5 per share. And as a general broad rule, I am far more interested in companies that trade over $100 per share than under $5 per share.
Okay. So just a general rule of thumb. Yeah. Like the cheaper a stock, yes, it may be like easier for you to afford it, but it doesn't make it a good company. So sometimes you are just better off saving and then trying to buy one share of a company that you think is like a good buy or a good value company.
And the great news is that nowadays, there are ways that you can buy fractional shares. So let's say you only had $200, but you wanted to become a shareholder of Amazon. You could actually buy 1/10 of a share of Amazon. And so you can invest your $200 and become a teeny tiny owner of one share, as opposed to having to need $2,500 to buy one share of stock.
And actually, I just did that recently. So Amazon was a company I always wanted to own, but I could never justify spending, over $1,000 on one share. So since Robinhood has started allowing fractional shares, I own a little bit of Amazon, and I'm just slowly building up. And it's great. Yeah, you can say, all right, I only want to put $200 into this particular company, or 100 or 50, whatever it is. And now you can be a little bit more, you can think about your group of stocks, or your portfolio is what we would call it. In terms of dollar amounts, you can say, okay, I want this amount of money in each of these stocks. And you can divide it up a lot easier now using this fractional shares approach. Because before you had to buy like a whole stock, and then, if a stock of Apple is $300 and a stock of Google is $1,000, like you'd have to buy a lot of Apple stocks to kind of balance out how much you own in both companies. So this makes it a little bit easier for you guys to kind of manage what you're buying and how much you're putting into each one. How many stocks are there in, let's go with the US roughly? Do you know?
I don't know the exact number, but it's more than 5,000.
It goes up on a regular basis, I'm sure. But yeah, there's a lot of stocks in the US. There's also these different words that we hear about, like an S&P 500, a Dow Jones, a NASDAQ. Can you tell us a little bit about what those are?
Yes, those are terms that are quoted all the time in the news. And if you're like me, I never had any idea what those things meant. All that I knew is that when the prices went up, that was good for some reason. And when prices went down, that was bad for some reason. So yeah, let's talk about each of those. The three most commonly quoted stock market indices in the United States are the Dow Jones, the S&P 500, and the NASDAQ. What those are is a collection of stocks, of publicly traded stocks that meet certain criteria. And all of those stocks are combined together and to create a single price for all those stocks, the value of all those stocks combined. And when you hear a number quoted in the news, it means that what they're telling you is how much that basket of all those stocks together went up or down in any given day. Now, what I found fascinating was the Dow Jones Industrial Average, which is one of the most widely quoted, is only comprised of 30 companies. The S&P 500, by contrast, has, Rob, any guess how many companies?
Ooh, it's a hard one. I think this is a good trivia question too. Isn't it like 504 tickers in there? But yeah, it's 500 companies.
It's 500. Yes, yes. You're precisely right. But yes, the answer is 500. Whereas the NASDAQ is 100 companies that meet certain criteria.
Mm-hmm.
So when you hear those things quoted in the news, with the Dow Jones, for example, let's say the Dow Jones was up 100 points today. What that means is the 30 companies that are in the Dow Jones, when combined together, the average of those went up by a certain point basis. But the more important number to pay attention to is the percent basis. So if the Dow gained 1% today, then that means that those 30 companies on average went up by 1% in a given day.
And this is really just for kind of giving people a general snapshot of what is the US doing on a certain day or a certain time. So if we say we want to know how is the US stock market doing, using something like the Dow Jones or the S&P is just a good way of kind of getting a rough indicator of, okay, what is actually happening. So if the top 500 companies are in general going up, we would say, all right, well, the US stock market is pretty much going up. Dow Jones, same thing. NASDAQ is just another group of stocks that can be used to get another type of measurement for the US stock market.
Yes, that's exactly right. It just gives you a snapshot on any given day to how much the stocks in general rose or fell. But as you can tell, with the Dow Jones, it's a very small number of stocks. Now, those are some of the largest companies in the world that are in the Dow Jones 30. But as a reminder, so I have the number in front of me, there's 6,676 publicly traded companies in the US, and the Dow represents 30 of them. The S&P 500 represents 500. So a lot of professionals on Wall Street pay more attention to the S&P 500 than they do the Dow. Although, believe it or not, the two things track each other extremely closely.
Okay. So I just want to give everyone at home like a little bit of a visual of what the S&P 500 kind of looks like. So this is a site called finviz.com. And what we're looking at here is basically the S&P 500 broken down into little boxes where each box represents one company in the S&P 500. And the size of the box is corresponding to how big the company actually is. So you'll be able to look at this and you'll be able to say, oh, I recognize maybe some of these names. Like what you're seeing is an abbreviation of the company that is called a ticker. And some tickers look a lot like the company they represent, some do not. So for example, I'm sure you probably could recognize this as Amazon. What you may not have known is that something like KO is Coca-Cola. So this is a good visual of like what the S&P 500 actually looks like. And you can see that there are a lot of like really small companies in here, but there's only a handful of really big ones. So when you are picking a company or when you're looking at something like the S&P 500, not every business is the exact same size. And that's like important. There are bigger ones, there are smaller ones. And even when you go into the top 500, there's a very big difference between the top 10 and the bottom 10. So Brian, how do we like even start thinking about like what makes a good business? Like how, if I wanted to buy a stock, like what would I look at or what would I look for? If I'm like a high school student and I'm like, I want to think about buying my first stock. Do I go with the biggest boxes on the grid here because those are the biggest? Do I go for ones maybe that I've heard of before? I don't know much about stock investing. So like, where do I start?
The first place to start is by learning about businesses and learning about stocks and learning about businesses in general. Now, if you were just going to be picking stocks at random, some of the big ones on here, Amazon, Apple, Google, Facebook, Microsoft, these are big for a reason. These are some of the best companies in the history of mankind. These companies all have sprawling operations. They're highly profitable. They sell products or services that are used by millions or even billions of consumers. They have a lot of cash. They have very little debt, and they have very strong competitive positions. That is a big reason why they have grown over time to become some of the biggest businesses in the world. So if you're just starting out, a great strategy can be to buy some of the biggest, most well-known companies that you yourself know and love and are interested in. For example, if you really like YouTube, do you know who owns YouTube, Rob?
I do. They are owned by Google, aren't they?
That is correct. Google owns YouTube. So if you're interested in investing in YouTube, look at Google. Take a look at its company. Take a look at how it makes money, how much profits it has, how much cash it has, how much debt it has, what are its long-term growth opportunities. That can be a great way to learn about companies.
Yeah, or you love your iPhone, so maybe you're going to think about buying Apple because you love the product. You know they produce good stuff. You're really big into like Call of Duty or Madden or any of those video games. Who makes the video game? Is it Activision Blizzard? Is it EA? Those are both companies that you could buy. You love eating at Chipotle. You can own stock in Chipotle. There are some companies that you can't buy stocks in. So that's important, that if they have not gone public yet, that means they are still privately held. So somebody still owns all of that company. Big example of that, especially over here on the East Coast, is Chick-fil-A. I always get kids being like, I want to buy Chick-fil-A stock. I love Chick-fil-A. And it's like, well, sorry guys, you can't. Chick-fil-A is still owned privately. So they're not available for the public to buy yet. Okay, so let's talk about, so this is individual stocks. And well, what if I said, I don't like the risk of buying just one stock, because you know what, if you just have all your eggs in one basket, you know, that kind of saying that goes with it, then you run the risk of one stock kind of going down and all your money going down. So usually what we say is, all right, we're going to spread our money out. We'll buy maybe a bunch of stocks. Is that a good strategy?
Yes, that is a great strategy. In fact, a wonderful strategy, especially if you're just first starting out, is to not buy individual stocks at all, but rather buy a basket of all of those stocks in one. So we talked before about the S&P 500. There are funds out there that you can purchase one share of a fund, and it owns all 500 of the companies that are in the S&P 500. So buying those funds, which are called index funds, can be a easy, fast way to get your money invested in the market, get your money invested in some of the best businesses that have ever been created, and taking on no individual company risk. So we talked about Google before. Google's a phenomenal company. I think it has a very bright future ahead, and it's a stock that I own personally. However, if you're just buying Google, what happens if something happens to Google? What happens if another search engine comes along that displaces Google? What happens if another video streaming platform comes along that displaces YouTube? What happens if Google gets into trouble for some reason? That could cause Google's share price to decline. So buying Google's stock is a little bit riskier than just buying a basket of all 500 of those companies. By spreading your money around and by diversifying amongst a bigger group of basket, you lower your risk.
Yeah, so like the basket idea, guys, would be, say, you saw that screen with all of the 500 companies from the S&P 500. So say the example would be, I went and bought a share of all of those, and then I offered to you the chance to buy a small fraction of my entire ownership. So you're really owning a fraction of all these companies, but you own a little bit of all of those companies. So some may go up, some may go down, but in general, like, we hear that the stock market in general goes up. Is that true, Brian? Why is it better to own more? How does that help us?
Yeah, so by owning more companies, you increase the chance that the entire value of your money that invested is going to go up over time. And the stock market, specifically the S&P 500, generally rises by about 8 to 10% per year. Importantly, this doesn't happen every year. In fact, if you looked at the returns of the market over time, they're very erratic. Some years the stock market is up 30%, other years it's down 20%. So you very rarely get that return of 8 to 10%. However, over a long period of time, there are generally more ups than there are downs. And therefore, the market on average has grown by about 8 to 10% per year on average over time for the last 100 years.
Okay, so there is going to be this risk, guys, that the market will go up, the market will go down. By owning 500 companies instead of one, you're reducing the risk that, you know, your one company is going to go dramatically down and dramatically up. So if you own 500 of them, some may go up, some may go down. And the idea is that the average of all of those will, in general, just kind of slowly go up by somewhere between 8 to 10% per year. Last year was an amazing year. It was like 30% the stock market went up. And this year it's probably going to be less so because of our current pandemic situation. But what's important to remember, guys, is that in the long run, so we're talking about now, you would own a stock and you're going to try and hold on to it. You're going to sit on it. You're going to hold on to it. You're going to let that company have a chance to grow and let the stock price go up, maybe pay you some dividends as well. what I don't really want to encourage you guys to do is this idea of buying a stock, seeing it jump up like a little bit and then be like, oh, I got to sell it right now. Or it goes down a little bit and I got to sell it right now, or I got to buy more. That's a dangerous game to play. And it's a very, I would say it's a specialized kind of game to play, Brian. Would that be right? That some people do buy and sell stocks on like a daily basis, but they spend a lot of time kind of studying the markets. And
Yes.
how would you describe that? What I'm talking about?
Those people are called traders.
Okay.
People that try and buy and sell stocks rapidly in an effort to make money. That is a loser game. There's no way to do that.
I was trying to be nicer, but okay.
Well, I'll give you my opinion. I think that trying to do that is a complete loser game. You are trying to make bets based on short-term price movements of stocks, which are completely random. And even more crazy, nowadays, computer algorithms are making those buy and sell decisions for you. So if you are trying to buy and sell securities and make money in, say, a given day, you're literally competing against robots. Good luck if you think you can beat them.
Okay, so yeah, what we're talking about is people who will buy a stock, they'll wait for it to go up a certain amount, they will sell it, so they will lock in that little bit of money that they made. They'll wait for it to drop again, maybe buy it again, wait for it to go up, sell it. And it's a loser's game, as Brian says, because you have no idea if that stock is going to go back up, if it's going to keep going down. You don't know what it's going to do. Which kind of brings up the question, Brian, what causes like a price of a stock to go up or down on a given day? Like I get over a long period, a company's value is going up. They're getting more profitable. They're making more money. They're making more things. So it makes sense like in the long term for a stock to go up. But why is it always like a crazy wave of price going up or down?
Yep. There's a bazillion things that affect what a stock price does in the short term. For the market in general, it really depends on the mood of investors, the mood of people that are buying stocks. If they are having a good day and they're feeling optimistic about the future and they think that profits are going to grow, they're going to buy and stock prices are going to slightly go up. If they come in and there's some terrible news items, such as a global pandemic, they're going to get fearful about the future and they're going to sell. And there are literally thousands, if not millions of people that are making those buys and sells decisions every single day. And all of those combined together make stock prices go up and they make them go down. So when you're trying to invest or trade for the short term, what you're betting on is short-term human emotions based on the news.
Well, that's predictable, right?
It's completely This is why it's completely impossible to predict what stock prices are going to do in the short term, because the mood of the market shifts up, goes up and down, up and down. However, what matters over the long term with a stock is profits. Is a company growing its profits over time? And I have a nice little animation here that I would like to show that kind of showcases this in process. So I want you to imagine that what I'm going to show you is an animation of a man who is walking up a hill, and this man has a yo-yo. And the yo-yo represents the prices of stocks. They're going to go up when when everybody's feeling good about themselves, and down when there's bad news. Up and down, up and down. However, the man is walking up a hill, and that hill represents the growth of profits. So this is what happens to stock prices in the short term. They go up when things are feeling good and down when they're feeling bad. Up, down, up, down, up, down. However, what matters in the long term is that green line. That's the growth of profits over time. So as long as profits of all businesses grow over time, you can be pretty confident that 5 years from now, 10 years from now, 20 years from now, that prices will be much higher. But trying to predict what they're going to do in the short term is trying to predict the mood of the market. So that's why we always tell people you have to invest for the long term, because short term is unpredictable, the long term is predictable.
Yeah, so this is where you are either trying to say, okay, what are companies that I really like that I think are going to be around for a long time? They do a good job, they have a good product, So like the ones that you use on a daily basis, the ones that you hear about in the news a lot, like those are typically your bigger companies that are doing good things, or the ones who've been around for a long time. So you think of like Coca-Cola, like they've been around for decades, and they're a company that is probably not going anywhere anytime soon. So that would be a company that like you could say will most likely be there in the future. Whereas like some of these newer companies that you only just started hearing about, like they could disappear again very quickly because they haven't been around for that long a time. You don't know if they're going to stay profitable, they're going to keep growing. This is where, again, going back to that index fund idea, that's why I love index funds, because I don't trust my own ability to pick these companies that are going to be there in 30 years time or who are going to keep making money. Whereas if I own the entire market, then I can afford for some companies to go bankrupt so they can go to zero. That's fine, because there's going to be other companies out there who are going to make even more money. And the nice thing is that the lowest a company can do is go to zero. So any company can go bankrupt, their value goes to zero. But in terms of how high they can go, the sky's the limit. There's no limit to how high a company can go. So there will be, the bottom 10% of your business will go to zero. The top 10% will rise by so much that overall the value of your index fund is probably going to go up over time and go up by quite a bit, I would imagine.
Yes. In fact, that's why investing works in the first place. I love your point there. Let's say you bought $100 of a stock. The worst that stock can do is 100% loss. So your $100 literally becomes worth zero. You've lost $100 on your investment. There's no limit to what the best a stock can do. And let's take a look at one of the best stocks of all time, of the last 20 years that everybody here is familiar with, Amazon. Amazon has literally gone up in value more than 400 times. If you bought Amazon when it came public in 1997 and you put $100 into it, that $100 is now worth $40,000. So that's the potential upside. The potential downside is losing that $100. You can see it doesn't take a lot of Amazons for you to become fabulously wealthy in time. However, finding the Amazons is extremely difficult, which is why a great strategy can be, instead of trying to look for the Amazons of the world, you just buy all the stocks and know that you are going to own the next Amazon, the next Netflix, the next Nike, and you're going to also own a whole bunch of stocks that do poorly. But as a group, your money should continually go up over time. Awesome. Love that. All right, Brian, is there any other advice that you would love to give to our beginner investors out there? So thinking about getting started, is there anything you want to kind of share your wisdom, your guidance, your experience? Anything else? What do you Read. Connect with other people. Ask questions. Buy things. Make mistakes. Experiment. Now is the time to put money to work and learn about this kind of stuff. The wonderful thing about investing is that the earlier you get started, the more money you'll make over time. The more money you'll have later on in life, because small amounts of money, when consistently invested well, rapidly can become huge amounts of money. And when I say rapidly, I mean in 20 years. Rapid. Which seems like an eternity. a lifetime for an 18-year-old, yes. But literally just $100 a month invested wisely can become more than $1 million in your lifetime. And if you want to become a millionaire, it literally just takes $100 a month and patience. So you have to have the patience to be able to wait, and you have to be able to say, all right, I may have other goals right now. So this is what I hear from my students a lot. I would love to start investing, but I got college coming up. I maybe want to buy a new car. Maybe I want to buy that first house, and they wait. And a lot of people do this, guys. They wait until they get to like 30 before like, oh, you know what? Now is probably the time to start investing. But you've lost at least 10 years of where that money could have been growing and compounding. So that compound interest idea that the money is growing by a percentage rate. So you see it grow slowly and then up, that kind of hill that Brian showed us. And the more time that your money gets to do that, the more the value of it's going to be, or the higher the value it's going to be
by the end when you say, okay, I want to retire, I want to use this money, I want to start selling these stocks. So really encourage you guys to think about what Brian said. Like, can you find $20, $50, $100, something every month that you could put into an investment? So even if it's just an index fund, find an index fund that is like the S&P 500 or the total US market, or you can even find one that does the entire world, and just say, all right, we're going to put it in there, we're going to let it grow. And then maybe when I'm a little bit older and I want to get more serious about it, put more money in, I can, but at least I've started.
Exactly.
That would be my best advice to you guys.
I have a great picture for you. Here is what happens to the value of $1 invested depending on your age. If you start investing at age 20, by age 65, $1 should turn into $18. If you wait till age 30 to start investing, $1 will grow to be worth about $9. Still good, but literally half as much if you started at age 20. If you wait to age 40, $1 grows to be worth about $5. And if you wait till all the way to age 50, $1 only becomes worth about $3. So $100 invested at age 20 should literally turn into $1,800 by the time you're 65. What happens if you start when you're 15?
It's got to be over 20, right?
Exactly. So that's the magic of investing. The earlier you get started, the more money you will have when you get older. Warren Buffett, I hope that everyone knows who Warren Buffett is. If you don't, he's one of the greatest investors of all time. He's literally worth, I think, $80 billion with a B. Mm-hmm. The reason that Warren Buffett is so rich is because he started investing when he was 12.
12.
All
right.
Warren Buffett literally started investing consistently since he was 12, and he is a phenomenal investor. But the reason that he is so rich today is because he started earlier than almost everybody else in his age group.
Because he's close to like 90 now, right? He's like 80
almost
something.
90 years old. Yep.
So he's had a lot of time, guys.
Yes.
And I will say one thing: if you are 12, or under 18, you will need a parent's help to get started. So you'll need what's called a custodial account, which is where your parent, kind of like your bank account, a parent goes with you, or they help you set up your account, and it's under both of your names until you turn 18, and then you can take full ownership of it. So it is possible for you to start investing when you're under 18. So don't let that be a reason that stops you. You can get started now. You just need a parent's help to get started.
Yes. Get started. That's the biggest takeaway from today. Get started.
Now, go. All right. Brian, thank you so much for joining us today. Where can people find out more about stocks or hear from you a little bit more if they're interested?
Yep. The best way to hear from me is to connect with me on Twitter. My name is @Brian Feroldi, BrianFeroldi. I also highly recommend the company that I write for, Fool.com, FOOL.com. We have all kinds of information on there for teaching people what they need to know about investing.
Awesome. Brian, thank you so much.
Thank you, Rob, so much for having me.